Hello everyone, welcome to a new video. In this video, we're going to be doing a price action review. So I'm going to try and make this a bi-weekly thing, or maybe if I have time, I'll try to do videos like this on a daily basis, covering the doubling theory times power 3 expansion as I have been teaching you guys, so that you guys know how to, or rather you guys can get the experience through my price action reviews, like how ICT does with his concepts. You can do the same thing with mine and hopefully grow from there. Okay, right. So moving forward, this is gold in Friday's price action. So that would be yesterday's price action. Okay, if you look at the top left corner, it says December 1st, but we are actually referencing. Actually, yeah, we're referencing December 1st. Okay, so we're referencing December 1st, right? So in this case, we have we have the entire framework given over here. Yeah, sell side liquidity taken on Thursday. This over here is my N30 projective terminus, so there's a very specific condition for this as well, which we will be going through in a bit. And we can see that price took out sell side liquidity during the opening hours of the New York session, and then price proceeded to rally heading into the projective terminus. Okay, so we had three high impact news drivers, one at 9:45, other one at 10, and the other one at 11. Okay, so I did call out this move in the mentorship group with everyone that's in the private community, but we didn't really get in any trade because we are taking a break from the markets this week due to the fact that there was a lot of extra wicks in our fractal dealing ranges, which caused us to get stopped out very easily. That's the nature of the upcoming price action in December. So unfortunately, no one is safe from that. So the only way you're going to be safe from it is by going for 1:1 trades, by taking trades with larger stop losses, or by even taking negative risk reward trades. Now, I know some of you may not agree with that because you guys have tighter stop losses than I do. Well, different folks, different strokes. Different folks, different strokes, right? Okay. So move on. Yeah. Now we'll drop down to the 5-minute chart, and you can see we're looking at that same sell side liquidity pool being taken. And looking at the entire three-part division for the day, you can see that this is accumulation, this is manipulation, and then that's your distribution. Okay. When we took out this sell side, and once we started trading above this down close candle, that is a change in the state of delivery from my point of view, from the way in which we look at things in the trading academy. We take out the sell side, which is also a stacked liquidity pool. And how do you know by now what is a stacked liquidity pool and what's not? A stacked liquidity pool is one that has mitigations, an order block mitigation, right? So in ICT speak, you guys would call it low resistance liquidity runs, but for me, that is a very vague concept, right? It's not as simple as saying there's a lower high, higher low, or a lower high. Okay, that is not enough, right? There must be an order block mitigation for me to consider that to be a low resistance liquidity pool that is a candidate for a low resistance liquidity run. Okay, right. So we took out sell side. We've validated the order block as I have been teaching on this channel for a while now. We meander around. It's okay. It is what it is because we have high impact news drivers coming in. But if you understand that this is indeed the manipulation phase, price is not going to go below this low. Okay, price won't go below that low. So what you can do is you can enter over here and you can use one of ICT's concepts, which is severely underrated. I don't see anyone else talking about it. If there is anyone talking about it, do let me know, okay, in the comment section below, and I'll be sure to go check them out. But I have been discussing this with the mentorship for the past 3 years, even before it became popularized, if it is popularized, known as the external range demarker. Okay, it shares the same characteristic of a rejection block, but an external range demarker is a rejection from a point of interest, ideally a fair value gap or a fair value gap variant. Okay, so you can use external range demarkers to get in your trades. For instance, here's an external range demarker right there. The only way, or rather the way in which you're going to categorize something as an external range demarker, from the way I look at things, because when I look at things, I'm looking at it from a very mechanical perspective. The wick must be greater than the size of the body. That is what makes this an external range demarker. Okay, must react, for instance, at the inverse fair value gap low, right there. You are waiting for price to trade above the external range demarker's candle there and come back into the external range demarker to get a buy. You can buy over here. You can keep your stop loss below this low, and then you can follow the projection that I showed you guys earlier. Okay, that is the only way in which you can get a high risk to reward trade using ICT's concepts. Okay, because that provides you the framework of saying that, okay, if this is the external range demarker, then in this bullish example, we know that if we enter inside of the external range demarker, price will not revisit the external range demarker's low. Okay, it will not revisit the external range demarker's low. So we use the bullish order block inside of the distribution phase. Okay, right there. And then we start to make our way up. This inside your distribution phase, this is when you can apply ICT's market maker models. Okay, that is the only time in which you can use ICT's market maker models, or alternatively, you can use my fractal dealing ranges. So my London fractal dealing range. Okay, or my New York fractal dealing range. I have 10 dealing ranges. Okay, I have 10 dealing ranges. So you guys only get one. All right, so sorry about that, but it is what it is. So then we have the high impact news drivers here, and here, this where Powell speaks. We run up. This is an inverse fair value gap. How? Look. You see this gap here? You see how this candle, how the body respected this gap. Okay? The body respected that gap. So when we are thinking about which fair value gap is the inverse fair value gap, you're looking for the rejections and the closures against a fair value gap variant. For example, if the body closure was up over here somewhere, then that is your inverse fair value gap. But in this case, it's over here. So that rejection tells me that, okay, there was a reaction. Yeah, but the reaction failed. So now this becomes a new area of reaccumulation. So in the group yesterday, I told my mentorship guys, I told, okay, you know what? Price is distributing. Now it's going to start reaccumulating. It reaccumulated here, and then off it went to terminus. Okay. How could you have gotten in this move? Well, here's how. See how once we trade above, we came back down, rejected, and then started going up. Now, this is your candidate for an external range demarker. So your external range demarkers, they're best seen on the 15-minute chart. But if you want to really dive down and dig deep, you can go to the 5-minute and even better 1-minute chart. Okay? As long as you know what you're doing. Right? So you can enter here. As Powell spoke, it came down into it. You could have put a buy, and you could have kept your stop loss down here. Up it went. Alternatively, once this wick occurred, you could have entered again when price revisited this external range demarker right there. And in this case, this is also a rejection block because we took out sell side, we rejected, came back inside the range. And that would be a condition for a rejection block entry. Then if you just focus your attention here, that's a fair value gap reaction. The wick is greater than the size of the body. We go above the high of the candle. come back down into the wick. That's another external range demarker indicating that if you go long here, you keep your stop loss below the external range demarkers low, and you can look for price to continue its run up. So as you can see in red, these are the guys that will give you your minimal drawdown entries. Now finally, this is how everything looks like on the 1 hour chart. Here's how I got my projection. This is Thursday's price action. Thursday took out this stacked liquidity pool. Now, how do you know it's a stacked liquidity pool? It's because we took out stacked liquidity here, validated this rejection block there, price used this rejection block here, went up. In between, we have this stacked liquidity pool. And when price took out this sell liquidity pool and then started moving higher, right? We have this down close from up there, down here to contend with. And that is going to be the manipulated range that you will be using to go use for your profit targeting purposes. And at the same time, this is the candle that was responsible for taking out sell side on the 1 hour chart. You draw that forward, and that is your rejection block POI. And that's the resultant move. Okay, so I hope you found this insightful. If you have any questions, you can put it down in the comment section below. Okay, so it's a quick review video. Okay, I'll try to do this every day. If I can't do it every day, I'll try to do it once in a while in the week, maybe 2 or 3 times a week, and we'll see how it goes from there. Okay, so I'll try my best as possible to incorporate the doubling theory and the PO3 expansion explanation so that you guys can get some experience from that by looking at my videos. All right, so I'll see you in the next one. Good luck and good trading. Bye-bye.